Good morning or afternoon to some of you. Welcome to our panel. I'm Deborah Winshel, joining you from BlackRock, where I lead our global social impact team, and I serve as president of BlackRock's foundation. As you already know, today is a day focused on really talking about rebuilding and resilience. And in this panel, we're going to dive into short-term savings, which all of us, certainly in this conversation, believe is just critical to creating a financial safety net and cushion and really building and protecting and sustaining financial health for so many people. This conversation feels really more important than ever today as we're facing perhaps the biggest economic downturn since the Great Depression. But in reality, as we all know on this panel, this was a problem that needed to be fixed well before we faced COVID-19. And that's why we launched at BlackRock the Emergency Savings Initiative to help pilot, test, and build short-term savings innovations, and really in partnership with everybody on this panel. So let me jump right in and introduce our fabulous panelists. I'm going to start with Karen Andrus, who's the Director of Policy and Market Solutions and the Project Director of the Retirement Savings Initiative at the Aspen Institute's Financial Security Program. Karen works on advancing solutions for American families against really most pressing financial security challenges across a variety of sectors and disciplines. Mariel Beasley, who's co-founder and principal of Common Sense Labs, which is part of the Center for Advanced Hindsight within Duke University. They're a research lab focused on behavioral insights that influence people's decision-making around spending, saving, borrowing, and earning. Tim Flacke, Executive Director and co-founder of Commonwealth, a nonprofit that strengthens the financial opportunities and security of financially vulnerable people by discovering ideas and solutions and driving innovation at scale. And Joe Phillips, joining us from the UK, who's Director of Research and Innovation at Nest Insight, which is a collaborative research unit set up to really understand and address the challenges facing the Nest pension scheme members and other defined contribution savers as part of the UK government's auto enrollment. I should say a very good afternoon, almost good evening, Joe, to you. So thanks everyone for joining. We have a number of different perspectives on this panel today, and I'm really excited just to launch in. So Tim, I'm going to start with you. As you might have suspected, you've spent a good part of your career really working on issues related to financial security and empowerment. And you've thought a lot about the factors that come together to contribute to sort of the financial context of so many households in the United States, from cost of living increases, wage stagnation, health costs, student debt, and of course, not to forget the economic burden that comes with the structural and the systemic racism that's affecting Black and Latinx communities. We talk so much about all the challenges, but not as much conversation about the lack of opportunities and access for people to save. Can you paint a picture of why access to liquid savings is so challenging, particularly for low to moderate communities and for communities of color?
Absolutely, and it's such an honor to join this group today. So I'm really happy to have the chance. Deborah, I really want to pick up on one piece of what you said, which is the adjective liquid savings, or we might say emergency savings, because it's, as you said, I've spent a lot of time in the savings space, and it turns out that particular word is really significant. That still to this day, for so many of us, savings conjures up a long-term enterprise and a notion of rising balances over time. And that's natural for providers because frankly, the business case for that product is a lot clearer. And even when we think about emergency savings, a lot of us still have a kind of a model in mind of break the glass, a dire, infrequent emergency arises and we smash open the piggy bank and then we have something to manage through the crisis. But it turns out, what we really know now is that for the overwhelming majority of families, we're not talking about a break the glass moment. We're talking about a shock absorber. We're talking about something that goes up and down as they live through a really rough, bumpy ride. And it turns out, to your question about access, that particular kind of savings product, that up and down product, is still pretty hard to find. If you walk into most banks and you say you want to store a small amount of money and it's going to go up and down every week or every month, and the balance will stay fairly modest, they'll charge you a fee. Until very recently, Reg D has limited how many transfers could occur between checking and savings accounts, although I'm excited to say that's no longer true as of several months ago. So there's an opportunity there. So, even though we have a lot of savings products, that particular really, really important use case is very hard to find. And that's why we know AARP recently reported, based on Financial Health Network's Pulse data, that 53% of US households still don't have an emergency savings account. And as all of my colleagues here know, that's driving us to look for new platforms and new distribution systems like the retirement system and the workplace and retail outlets, maybe the 529 education system, health savings accounts, technology platforms that might be much better suited to these liquid up and down saving tools. And these systems have characteristics. They typically have scale. They have, frankly, incentives to focus on near-term worker or customer or stakeholder financial security. And many of them operate with a sort of public license that really gives them special advantages and opportunities to serve and make it logical that we might expect them, to play a part in what I think we would say is truly a public crisis. I did want to circle back to what you so rightly noted, that there is a clear racial dimension to this challenge. And this seems like a moment when we really, really need to stop and acknowledge that. We had a chance to do a little bit deeper analysis by income, race, and gender of the widely cited $400 stat from the Federal Reserve, which is, would you be able to handle a $400 expense? And it turns out that for 2019, the data's recently out, and 34% of us say, without any income restrictions or race specialization, that we wouldn't be able to handle a $400 expense. If you cut that by households under $60,000, it jumps from 34% to 52% who say they wouldn't be able to handle that expense. If you then look at women respondents under 60K, it jumps further to 57%. And then when we look at Black households living under $60,000, 70% report they wouldn't be able to handle a $400 expense based on cash equivalents. So we can see, a figure that we all have heard, whether it was 42% a couple years ago or apparently 34% today, is dramatically different when we begin to disaggregate and really cut it. So I think we have more statistics. I won't get into them right now, but I think it begs the question, what do we do about it? I want to say clearly, we don't feel we have all the answers. I do think we know that the banking system and financial services, like frankly, much of America, has a history of discrimination, particularly against Black households, from redlining from redlining to recent accounts we've read of pretty overt racism in bank branches. And it certainly seems we see that reflected in the data. So both the Commonwealth and as part of the Emergency Savings Initiative, we've really, one critical thing is we're trying to focus on the institutions and the systems and recognize this is not an individual level problem, whether we're talking about racism or financial insecurity. This requires being conscious. I mentioned the retirement system as a promising platform. We know that the Pew research tells us that while 63% of non-white Hispanic workers have access to workplace retirement savings, that figure falls to 56% for Black non-Hispanic workers, 55% for Asian non-Hispanic workers, and down to 38% for Hispanic workers. So we have to be paying attention to those kinds of issues as we work on this challenge.
Before we talk about solutions, which I know you referred to, I think it's just, there's a moment to pause, because I think it's so surprising if you're not that familiar with this space, when you think, well, people aren't saving because they don't have money to save. But the first thing you talked about was the lack of access to, attractive savings vehicles. I wonder if the panel can just stay on that for a minute and talk a little bit about, why is that the problem, as opposed to it's a cash flow issue, which of course is a component of it. But I think this is a unique dimension that not everyone hears about.
Yeah, so I'll jump in on that. So, Tim really kind of talked about some of the real challenges around how products aren't really built to be liquid savings products. Essentially people that helps control and shape how we think about and use those products. Because the products aren't really built and designed to be highly liquid, what that also means is that people are reluctant to use it as a liquid space. So even though, when people say, oh, what do you mean there's no access? You go to any bank, there's savings accounts and, X, Y, or Z, but it's really about how, we know that from a behavioral perspective, that many households, when they have to make a withdrawal from that savings account, they actually feel like it's a significant loss and a failure. Rather than the account served its purpose. And so you actually do see a lot of people who have had great savings behavior, have an emergency, make a withdrawal, and then don't refill it because it was such a defeating feeling. Because the product is not built to sort of feel like it's this liquid refilling, emergency savings vehicle. So I just kind of want to highlight that it really is that the, poorly designed products inform, or less optimally designed products really inform how we interact with those products and how we think about, understand, and use them, which then essentially what happens is people say, oh, I might have an expense. We actually did an experiment a few years ago where we tried to prime people with thinking about an unexpected expense as a way to get them to put money into a savings account. And what we found is it backfired. That actually by priming people to think about an emergency expense made them less likely to want to move it into a savings account, because they were like, our thoughts is that it's because people are like, oh, I might need to spend this soon. I should keep it in my checking account because I don't want to have to withdraw it from my savings. So it really is sort of, the product has really informed the mental model that we have about savings, which really prohibits people accessing and using them in ways that are actually, incredibly beneficial to their financial health and well-being.
I think Mariel's talked about the money, kind of when you take the money out of the savings account, but I think the other thing is kind of when you put the money into the savings account. So, the model is either sort of save money when you remember on an ad hoc basis, and we know there's lots of behavioral barriers to that, or there's an automatic savings mechanism that relies on a kind of regular pound or dollar amounts once a month. And, a lot of people aren't paid once a month. They may be paid weekly, or in the case of self-employed people, they're paid in a kind of variable and uncertain way. So looking at ways that people can make savings automatically, but also flexibly, that those two things aren't a trade-off. So a percentage of every payment paid through a payment app, or a percentage of every invoice paid, or a variable amount depending on how much I'm paid that month. It just feels like it opens up saving to a wider group of people.
And I'll just add, we have to think about the plumbing of our system too, right? And if you think about the US plumbing compared to other countries, whether Canada or the UK, we don't have a real-time payment system. We have a very fragmented financial services marketplace, to circle back to the point about racial discrimination, by far in this country, those who are unbanked are disproportionately Black. And so while on average over the past, decade or two, we've seen significant declines in the rate of unbankedness, largely thanks to technology, to fintech, et cetera, there are some places in this country you can go, places in the Mississippi Delta, for example, and you still find high degrees of people without bank accounts, or people who have a bank account but really don't use it. And there are a lot of reasons that go into that. But I think both the design of the accounts that are available and also the general plumbing of our system. You go to Canada, and there's a law on the books that says, except for in a few instances, of criminal behavior, everyone in Canada has a right to a bank account. That is not the case in the United States. And so, I think we need to look kind of broadly at the system of plumbing that has really prevented full access to even imperfect savings tools.
Karen, we're going to come back to the system of plumbing in a few minutes, but I'm going to come back to Mariel first. And can you talk a little bit about what we're seeing right now? This group has talked a lot about savings in an emergency. And now here we are facing an emergency, and we're seeing lots of different trends. We're seeing, at least for the moment, savings rates increase. We're seeing people withdrawing from emergency funds and also their retirement funds, because there's the opportunity to do that right now. And so a lot of mixed behavior. Can you talk a little bit about what you're seeing in terms of why you think this behavior is occurring, or what's sort of underlying this behavior? And also, what are some of the lessons in the midst of this that we could take away and perhaps could help inform some of the ideas and solutions that everyone in this panel has been thinking about?
Yeah. So, so first of all, as you said, yes, we are seeing higher rates of personal savings, even paired with our extremely high rates of unemployment and extremely high rates of people who have had their income impacted negatively during this pandemic. And the way that personal savings rates are calculated is basically it's an inflow outflow balance sheet. And so when we see rising personal savings rates, it can also mean, and some of that is likely driven by the fact that even the people whose income hasn't changed, their spending has changed significantly. And part of this is because simply it's much harder to spend money right now. Folks aren't traveling. That's a major expense item. Going out to eat a lot less. There's far fewer entertainment options available outside of the home. And so there's lots of places where our expenses have really decreased significantly. And that is contributing in part to that increased personal savings rate. But however, we also do know from a behavioral perspective that these sort of large moments in history and sort of these moments that are incredibly salient and top of mind, and we're hearing about it everywhere, can really actually at the same time also increase motivation to sort of take protective actions. There's some great research that shows that the best time to be a hurricane insurance salesman is right after a hurricane, because it's that moment that is, it's very top of mind. People sort of, the risk is salient. They know people have been impacted. They're seeing it on the news. And it's in that moment that they are sort of most willing to go ahead and take that protective action. And so that's likely also what's happening in many cases with the savings. And so people are actually also making deliberate choices to cut their expenses, to put more money into savings. And we're seeing that also in some of our data with our partners. We actually very early on, we have a partnership with Capital, which is a fintech that does sort of automatic savings rules. And early on in the pandemic, we basically were able to track the percent of new users who were setting emergency savings as their first goal coming into the app. And what we saw is sort of pre-pandemic, it was about 2.5% were setting emergency savings as their first goal. And in the first basically month and a half of it really rising in the news, that increased to about 20%. So a massive increase. And we actually correlated that with the Google Trends search of coronavirus. And it actually correlates very nicely that the rise correlates with that, the saliency of the virus. Additionally, we are, early when the stimulus checks were first starting to be deployed, we did a planner where we asked people to think about what they were doing with their stimulus check and to sort of plan for it, to really stretch it. And what we found is that on average, people actually plan to try to hold 50% of it for later. People very salient thinking about, I might need this in a month, I might need this in 2 months, and really holding on to it. But as you mentioned, we are seeing that people are dipping into their savings. So we've just very recently completed a nationally representative study. And so we only have the early look results. We don't have the deep dive yet, but some of the sort of headlines are that a lot of people, so more than half, about 58%, have either continued to save as before or saved more recently than pre-COVID. However, the ways that the rest of the folks are sort of handling their change in income and whatnot is that they're either contributing less. So about 13% are, just basically saying, I'm just contributing less than I was before into savings. I'm now using that money for other expenses. About 20%, a little less than 20%, have actually actively withdrawn from their savings. And I would note that the most common reason why people have withdrawn is for those basic necessities. It's groceries, it's, utilities, it's really to meet, and the rent. Those are the top three. And then the last way is that actually we're seeing fewer people who are paying their full credit card balance. So people are also actually using debt to finance some of their, expenses, rather than, in some cases, rather than dip into savings, or in some cases, rather than, skip some of these real necessities. And as you also mentioned, we are seeing some people dipping into their retirement savings, and that was actually a allowed under the CARES Act to sort of allow people to dip into it without the additional penalties. However, with the data that we have access to and the folks that we surveyed, we're actually seeing a much smaller group of folks who are actually touching their retirement savings. We're seeing about 5% only actually rating their retirement savings. However, what we are seeing is that those who are rating it are rating all of it, which is very troubling. Also for, when we think about not just how people are coping now, but what's going to happen when those folks are getting ready to retire. And now they've had this major setback in withdrawing those retirement savings. So that's sort of what we're seeing. But getting to your question about what does this mean and how do we sort of take this as lessons learned for really preparing and building better solutions moving forward. It's basically, I think it really emphasizes that right now is the time to build those much better pipes, those much better products, those much better sort of smart automation. And, the reason why I kind of focus on that is because motivation is high. And so that's great. Let's use that motivation. Let's capitalize on that motivation to get people started. But then let's have that smart automation that Joe was talking about that really is tied to a fluctuating income that is sort of paired with that so that as people's income changes and fluctuate, they're saving what they can afford to save. And I think that's and at the moment that they're earning. And I think those are some of the really key lessons is that, people's income is fluctuating, but they're still very motivated to save. So we need to really lean in and develop some of those smarter strategies. And my favorite that I've, been pushing for a little while now. So apologies to anybody who's been on calls with me lately about short-term savings. Really, really thinking a huge opportunity is around splitting that direct deposit and, into a short-term savings and a checking account. As that key moment, it's timed with your income. It varies by that income. It's a really lovely solution and now's the time to do it, especially because as more people are coming back to work as part of the recovery, you're having now all of a sudden people have to go through and fill out the direct deposit forms all over again. So it's a really good opportunity to capture a larger pool of folks. And then the other thing that I would say is that, knowing about how people are dipping into their short-term savings, but also we're seeing some people are sort of nervous to touch it. That goes back to Tim's points about this, we don't really actually have a good concept of a liquid savings account. Is that this is also a time to really lean into the idea of savings as a cash flow tool, as a cash flow management tool, rather than as a, that shock absorber, rather than as just an accumulation account. And so, that's really thinking about, not just your checking and savings account structure, but really more of, your checking account, which is your daily regular expenses, your, micro savings account, which is actually just saving for the bills that are going to come later that month, but not yet. Your emergency savings account that is for those unexpected, shocks and changes and expenses that you aren't really planning for, but are going to happen at some point. And then your goal-based savings that really are those that are less liquid, that are, more protected and that are really gold, where the aim really is an accumulation account. And I think those are kind of the main strategies that kind of come out of the things that we're learning and seeing.
It's interesting. It always strikes me your split deposit mantra, because it goes back to, as often is the case, the simplest is the most elegant and the most impactful. And it's just a change that so many employers and others can relatively easily make, and that you've demonstrated has, pretty significant impact. I'm just going to, Joe, bring you in on some of the comments that Mariel made about behaviors and what you're seeing and solutions in the UK, because of course you operate in a different regulatory environment. You at Nest have been able to pilot this idea of linking short and long-term savings and creating that sort of liquidity for people to draw in an automatic way. Can you just talk a little bit about some of the observations that you've seen both pre-COVID and sort of in the midst of this around behaviors and some of the lessons that you're learning?
So I want to pick up on one of Mariel's points about this kind of motivation to save, but also the observation that some people are sort of saving by default now because they can't spend, but also some people are really not in that position. And, that split. So richer households are not going out and not going on holiday and not commuting and kind of saving by default. But then we also have, low income households where they're dipping into any savings they have or taking on debt to cope with essential food costs and bills. And what we've piloted in the UK, or what we're piloting currently in the UK, is a hybrid savings tool that gets to some of what Mariel was saying about, rather than things being separate sort of competing priorities for people, that you join them up together so that people don't have to make these difficult choices. So we're piloting a savings tool called JARS in partnership with Salary Finance, and an individual signs up to save an amount per pay period into JARS, and at first that money goes into an emergency savings account, and when it reaches the target for that emergency savings account, it automatically rolls over as an additional pension contribution on top of the contributions the individual's already making under auto enrollment pensions in the UK. I think just in terms of the observations, kind of pre-COVID and now, although that design was really well received by employers, by employees, by policymakers, by the industry, I think it's really important to note that take up of that is still quite low. And I think that really gets to some of the barriers that we need to overcome, some of the inertia, some of the difficulty of finding the time and the energy and the headspace actually to sign up for something, even if you want it and you think it's a good idea. And so one of the things that we're looking at going forward is whether we can add to that pilot an automatic enrollment into the sidecar savings tool, to really see if we remove some of those barriers, if we make it an opt-out rather than an opt-in, if we set some smart defaults around how much you save and what your savings target is, what does that do to participation rates? And then I think, just to go back to the group who are saving now and the group who can't save now, I think if we expand that idea beyond the flow from saving for the short term to saving to the long term, I think we also need to think about those people who Mariel talked about, who want to be saving, for whom saving is kind of looming large right now. The risk of not having savings is really top of mind. But if people can't save right now, what could we do to harness that motivation now? Because we know from other financial crises that the savings ratio drops again right afterwards. So are there pre-commitments that people can make now, even if they can't save now, whether that's going from debt to savings pathways, so agreeing that once that debt is paid off, that debt payment can turn into a savings payment. And we're seeing some employers thinking about that we're working with in the trial, that if I offer a hardship loan to my employees now, I could just talk to them about, we're going to plan that you pay this off within a year, and at the end of that, you could translate that into a savings payment, or even just setting up a savings pot and a reminder to come in 3 months' time. Can you do it yet? Just any kind of pre-commitment that capitalizes on this motivation and the salience of saving right now, but mindful that that's just not possible for a lot of households.
Yeah. It's interesting, the pilots that you've been running, you've learned so much about what doesn't work as well as what does work, in terms of how do you create that next level of, as we say, make it easy, make it automatic. And I think that's a lot of the lessons that we've been finding to help people have that opportunity to just save. It's so evident from the work you've done and from the studies that we've seen, and even the behaviors that we're seeing in COVID, how inextricably linked short and long-term savings are, and the criticality of short-term savings, even just, as a cash flow tool, yes, and all the ability to meet emergencies, yes, but also to protect and hopefully over time create long-term savings. Karen, you started out early on talking about the plumbing. Can you talk a little bit about what can policymakers be doing? What are the kinds of regulatory things that we could see that would really help create a better pathway to creating these opportunities?
Sure, thanks. And I should say too, thanks to our friends at Financial Health Network for having us at this conversation. I think I want to start by just saying, and I appreciated Mariel's drawing out, what is the purpose of emergency savings, right? I mean, we often talk about the proverbial tire that gets blown or the furnace needs fixing. And right now we are well beyond that. We are in a moment where I think, I don't think any of us think that there's an emergency savings tool or option that can cover 6+ more months of total income loss, right? I mean, I think we need to acknowledge that there's also a conversation here around insurance, social insurance, right? A more robust safety net that can catch people in this kind of catastrophe. But putting that aside, there's always going to be the blown tire and the furnace that dies. Or, like I think Tim mentioned, and I know our friends at JP Morgan Chase Institute found, this need for a slush fund that just covers that basic income volatility, right? Sometimes it's not about an emergency. It's just, I know that my income is going to go up and down and my expenses are going to go up and down at different points, and I need some float to help cover that. So thinking about those different purposes, we kind of come at this from the other end of what Mariel was saying. She was building up, right, from checking account to that really like that super slush liquid fund to the goal-based funds. What's at the other end of that is retirement savings. And so we're in this funny position in the US where we have built out this imperfect, and I'll get to that in a second, but very robust and sophisticated private retirement savings systems, the defined contribution system, right? The 401ks and the 403bs that so many of us probably at this conference have access to at work. And while that system leaves out roughly half of private sector workers, somewhere between 40 and 50 million people, disproportionately people who are female, Black, and brown, because they work for small businesses that tend to not offer those options. We do know that for those who do have those tools at work, they work really well. And part of the reason that they've been working really well is automaticity, right? Is we are, thanks to the work of Cass Sunstein and Richard Thaler, we now are mostly defaulted into it, right? To Joe's point, it's automatic. We're automatically enrolled into our 401k at work. I think our question is why can't we be automatically enrolled into emergency savings, right? And putting tax advantages aside for a second, right? We tax advantage retirement savings. We don't tax advantage short-term liquid savings. Even just the ability to sort of be automatically enrolled into emergency savings. So that's sort of, I'll come back to that, but I think that's one policy opportunity, is making it really explicitly clear, or creating an innovation sandbox around the ability to automatically enroll people. I think we're interested at Aspen, given that connection that you talked about, Deborah. We think that the short-term stability and long-term security are really inextricably linked. And you can see that actually in a few different ways with retirement savings and short-term savings. We know that I believe it's a quarter of people withdraw money from a 401k when they separate service from an employer. And we know that totals roughly $56 billion a year in leakage, right? People are taking money out when they leave a job because they need it. They need it for expenses. We also, and I think Mariel's team is doing some testing, so you can tell me if I'm wrong, Mariel, but I certainly suspect, many of us suspect, that there's actually a connection between people not enrolling or participating in their 401k because they don't have liquid savings, right? There are 22 million people in the US who have access to a 401k at work but don't use it. And so people know that if they put it in their 401k, they've locked it up. And they know that the tire is going to blow, and they know that they're going to want that money. And so they just never enroll, or they opt out. And so I think that deep connection between the two, between people knowing that they want short-term stability and they want long-term security, but our systems are built for it, means that I think we have an opportunity to pilot or test these systems like what Joe and her team at Nest have built and what they're studying. How can you take that payroll deduction and divide it into a variety of different pots or jars or buckets with different tax treatments or different investment options or not, different amounts of liquidity. But to build that would require some policy, if not change, then some clarity, right? The 401k system is largely governed by ERISA. We have banking regulations, to Tim's point, that would make it difficult to have the level of liquidity we want in retirement savings. And we've got multiple sort of layers of regulation and the different kinds of systems we could use to build this, that I think there's an opportunity for us to kind of lay it all out on the table and say, how do we make emergency savings automatic? How do we make it sort of tied to retirement security in a way that benefits both our short-term and our long-term? How do we make it simple and clear? How do we give payroll providers, record keepers, the clarity that they need to go ahead and pilot some of these solutions?
I'm curious.
And go ahead.
I was just going to say, I'm curious, Karen and probably Tim, is there a quick win from a legislative or a regulatory perspective that you think is on the horizon that would really provide a great opportunity for some piloting or even a significant change that would make a difference in this environment?
I'll take this, and then Tim, you can jump in. I do know that Senator Doug Jones of Alabama has introduced some legislation that would very explicitly say that there is sort of give the green light for automatic enrollment into workplace emergency savings accounts. And while we're sort of in discussion behind the scenes to make sure that that is as beneficial as possible to a wide variety of workplace emergency savings models, I think getting that through and putting that sort of on the map would certainly help elevate this issue, not just with other members of Congress, but also with some of the regulators that need to be involved to help work out some of the kinks. But Tim,
Great.
I don't know if you can add anything.
Tim, I'd love a few words, and then I am going to try to make time for questions, I promise. So I'd love if you have anything to add to that.
Very, very quickly, I think that what Karen described in terms of a legislative path makes a lot of sense. It also turns out if you go back and look at how we got to automation in the retirement system, that in many cases, employers went first before there was regulatory clarity. And I think this is a moment where we need to do that too. We're actively seeking to get as much clarity as we can from federal regulators, and we are in the market for an employer who wants to dance. We think we can do this and show. And it's really hard for me to imagine who the regulator is that's going to come after you for trying to figure this one out. So I think we can both, pursue the sensible sort of get it in writing path, and we can also go out there and build the evidence case that this is a good idea. And so if that kind of suits your character, let's talk, because we can do it.
Okay. So employers, Tim's dance card is open. Please call. I'm going to switch to a couple of questions. I think we have a few minutes. The first question that came in is very interesting for anybody, except for maybe Joe, sorry. What changes to the traditional savings account would you suggest would make it more accessible or available, compelling for liquid savings? So we talked so much about fintechs and all these other options, but what about the traditional savings account and the banks?
Yeah. So I think two things. One is that are just like immediately top of mind. I'm sure that you all have some additional things to add, but one is really, really emphasizing focusing on an automatic refilling feature within that account. So many of for the traditional savings account is that the default is that it's manual contributions. That you are, when you feel like you have extra money to save, you put it in there. But a truly liquid account means that it is constantly filling and coming back down, which means we really need to focus on those automatic contribution sort of ways that are built into that account that are really the automation first, rather than automation as a, added on thought for folks who want to put it in. And then the second piece that I would note is that, right now, the traditional model, and I sort of alluded to this earlier, the traditional model is a single savings account. It doesn't separate goal-based savings from liquid savings. And we really should think of those as two separate products and two separate accounts. And helping name those, I think, is also an incredibly helpful thing to do to help kind of reinforce that mental model that this is your rainy day account that will constantly fill and empty and fill and empty and fill and empty. And this is your accumulation savings account. So those are two things just top of hand that and every financial institution should. This is the other thing is that, unless you're a credit union, by default, most new account openings are not defaulted to open a checking with a savings. The big difference is sort of the reverse challenge at credit unions where the default is that you've opened a savings account and maybe not a checking account. Mm-hmm. But really thinking about account opening is about this sort of collection of account packages and thinking through the way that those work.
I'll just jump in quickly on the substance side. Minimums, fees, and transfers between transaction and savings. No minimums, preferably no fees, and now take advantage of the Reg D change. And then maybe to underscore Mariel's point, it's the substance really matters and the framing and optics really matters. And so people still don't get that this is there for their, for their day-to-day lives. So you got to figure out the branding. We've had great success with rainy day as a concept. And, I think there's a huge opportunity because after transactions, this is probably the most frequent financial need and event in many, 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 many of your customers' lives. And it's crazy not to figure out how to be present and part of the solution. Even if you can't drive revenue on that particular product line, like what an opportunity to be part of the solution of their day-to-day pain. Like that's gotta be something to seize.
If I could just jump in too, I would say, I think it doesn't have to be a traditional separate savings account, right? I mean, I think we've seen some providers like PNC, oh my gosh, over a decade ago, introduced virtual wallet that used bucketing and, that the interface told you it was separate money when really it wasn't. And I think, there is a question as to whether you really need it in a separate account, whether it needs to look like it's in a separate account. The other thing is, while interest rates have been very low for a long time, and we know nobody's getting rich off of the interest on their emergency savings or their savings account, what are you incentivizing? We've been incentivizing the building up of balances. Would it be better to incentivize the behavior? The action of saving, of continuing to save, withdrawing, and continuing to save, right? It's the action that we want to incentivize, not the buildup of the balance. And I realize that there's a business case question there, but from a user perspective, I think the question is, what do you want? What do you want to incentivize? What action do you want them to be taking?
I think we have time for one more question. Mariel, you mentioned, and I know everybody thinks about this, the self-defeating angle of an emergency savings fund. One of our product providers is asking what kinds of things can be structured to prevent that self-defeating component of a product. And I open that up to everyone.
Yeah. So in addition to having it be sort of this automatic process so that even once you've taken, you'd have to kind of go through extra steps to stop contributing to it. I think that's an important feature. But also I think that there's a lot more that financial institutions can do to celebrate when you've used that money and when you've pulled it out and to actually try to help you actually feel better. And it's sort of like, congratulations, way to go. How great that you had your back, like in this case. And, great, use it, and let's keep going. And I think that adding that element of, celebration, appreciation is really an important component that is missing, that helps reinforce people that it's okay to use this money. It's okay to touch it. And sort of emphasizes that in sort of the mental model we have around that savings account.
Jo, anything you've learned in sort of this regard that might be relevant?
Yeah, I think it's a question we've been asked a lot by people looking at the JARS savings tool. Can people take it out for anything? Could they take it out to spend on shoes? And what we've tried to do is build into the communications examples up front of times when you might want to use this money. So it's the unexpected fine or bill. It's the 3 sets of school shoes at once that you weren't expecting. It may just be Christmas presents, but what are the things that you put top of mind as a reason that people might want to have this savings pot and might want to use it. And then I absolutely agree in terms of celebrating reaching savings targets. And this is something that, some of those partitioned accounts are really good at doing. You set a target and then it celebrates when you've reached that target. And I think, given interest rates are not the main motivation to build up a small pot of emergency savings, peace of mind, knowing I've got something there, knowing I've got a buffer that will protect me against life's up and downs, I think that emotional recognition of having that savings can be really powerful.
And I would just to kind of emphasize, I think it's not only just about celebrating the targets, right? It's also about celebrating like when you've withdrawn, which actually feels incredibly like, I've said this to a couple of financial institutions and they're like, what? No, we want people not to withdraw. We want people to not. And it's like, well, you want to reinforce that that's what this account is for. And it's, they're actually using it to its fullest if they are indeed withdrawing it. And the expectation that somebody will just set it and reach all of a sudden $2,000 is just not realistic, right? I mean, we know there's lots of research out there that shows that, 60% of households will experience in a normal year, not even this year, but in a normal year, 60% of households will experience a financial shock. If they're not touching their emergency savings, they're covering that shock in other ways that might be less healthy.
Yeah.
I'll just say quickly, start with empathy, not judgment. Been doing this for a long time. Never met a person who didn't get that savings was a smart thing to do. They just need help to do it. Let that guide your approach in design and marketing, and you'll be a breath of fresh air.
Tim, I think that's such a great way to close, because I think as we got involved in emergency savings, the thing that was so immediately evident is that everybody wants to save. This is not, the first step is not convincing people to save. It's giving them the opportunity and supporting it and rewarding it or recognizing it. And I think that's a really critical takeaway for today, as well as I hope this conversation just underscores again the criticality of providing short-term savings opportunities for people's broad financial health for the short term and for the long term, and that there are opportunities for everyone, whether it's employers or record keepers or payroll providers or regulators. And I'm sure I'm missing a few, but there's so many opportunities to help create short-term savings vehicles that will help customers and employees and just a host of people who are really facing very challenging economic times today and imaginably for several years going forward. So I just want to thank our panelists, thank Emerge for giving us this opportunity, and it's been a pleasure being part of this conversation. Thank you.